All right, welcome back to the channel. Today we're going to be checking out Dick's Sporting Goods, ticker symbol DKS. And yeah, if you have not heard, they missed earnings really bad, and they were down like 25% in one day. So see that here, they were trading around 147, and they crashed down to about 110 or so. They're sitting at a 111 right now. And yeah, let's get into the 5-year chart and check out the volatility on this one. This has been crazy over the last 5 years. The 5-year low was 1681. The 5-year high was 149.73. Low to high was 790%. We're still sitting about 560% off of the lows, and we're about 25% from the highs. The 5-year return has been 207%, or a 25.19% CAGR. Versus the SPY, it's absolutely crushed the SPY. So let's go ahead and get into the earnings presentation. All right, so here we have the investor presentation for August 2023, just after their recent earnings release. They're guiding for 2023 full year EPS to be around 11.33 to 12.13 per share. During this latest earnings, they basically had revisions downward on their margins, and the market did not like that. They had issues with theft or higher levels of shrink than they were expecting. Apparently, they only do an inventory, or they used to historically only do an inventory once every year on their stores, and there was a lot more theft than they expected. So yeah, kind of had to revise their guidance downward based off of the massive amount of shrink that they were seeing, and the market did not like that. So basically what we're seeing is a little bit compressing margins from them. Now if we look at the previous couple of years, we can see the massive amounts of growth that they went through COVID, and then they're kind of moderating down. So their margins kind of followed suit, increase in margins through COVID, and then start pulling back in 2022. So we're just going to go over this investor presentation really quick. I'm not going to spend a lot of time on it because you guys should know what Dick's Sporting Goods is. If you don't, it's a sporting goods store. So yeah, they've got a bunch of sporting goods equipment. So let's see what they have to say and what they have to sell us on. So here they're just pointing out their reach, 150 million athletes in their database. So they have several different apps. Some of them are to do with like keeping scores of games and stuff like that. And then I believe they have rewards programs. So yeah, decent amount of people in their database. Their reach seems to be pretty far. Yeah, we got kind of a breakdown of their sales right here. Let's see if I can zoom in on that. So we got 24% footwear, 34% soft lines, 40% hard lines, and we have national brands and vertical brands. Here we got a good old TAM slide, 140 billion TAM, and they are about 8% market share. That's actually pretty good. 8% market share is pretty decent, and increased from 7% in 2019 up to 8%. So they are growing in the marketplace and taking a little bit more market share. And now they're pitching to us that they are a growth company. Ooh, get all the growth investors on there. And going through a transitional period over the last several years. We can kind of see that in the metrics and in the financials of their margin expansion and their growth over the last several years. Then we have a recent acquisition in March 2023, Moose Jaw. Never even heard of it, but it looks like it's an outdoor sports retailer. So it looks like they acquired them in 2023 and are kind of pitching the synergies between outdoors and traditional sports that they're in right now. And then here's that cute little app they got, Game Changer. I don't know, never even heard of it before, but looks like it's for like live streaming scoring statistics for youth sports. So actually a pretty good concept and a decent amount of growth and adoption in that segment, which is kind of cool that they're doing more than just, regular sports, that they're actually providing applications or services that actually are going to benefit the community that is buying from them. So that's kind of neat. And then we got their liquidation centers, it looks like. So Going, Gone. Looks like they just started opening these, and it's basically to just clear out clearance items and old inventory. So that's kind of a neat concept where they can just offload to here and then try to get it out of circulation quickly. And we got a slide just touting their relationships with different partners and brands. So yay, good on them. And a good old omni-channel slide. So in-store or 1 hour pickup or traditional, delivery. So basically however you want to buy from them, you can. So we got 90% of sales enabled by stores, 70% of online orders fulfilled through store network. So it's kind of interesting. Kind of reminds me of like what Best Buy is doing, where they're almost using their stores more as like a warehouse for delivery of their like e-commerce sales. So it's kind of cool. I like that concept, honestly. Having, stores that aren't not just for in-person sales, have a higher kind of take rate of actually delivering goods for the e-commerce side of the business. Haven't been feeling good lately, so just bear with me on this one. Yeah, and then they go into their digital experience. Okay, yay, good for them. They're taking advantage of that e-commerce. And I wonder if they'll say AI, data-powered technology. Oh man, data-powered. They should have said AI. Why didn't they say AI? Come on. Their stock would be up if they said AI. Then we got a good work culture slide here. 84% recommend DKS Sporting Goods as a great place to work. Yay. But is that down? Looks like that's down from 2023. So it's getting worse, guys. It's getting worse. Just kidding. So here they're trying to sell to investors that they have structurally higher sales and higher earnings from pre-COVID. So kind of their pitch of like, hey, this isn't like a cyclical event, that even when we go back to COVID or pre-COVID norms, we're going to maintain pretty good margins. And we actually heard that on their investor call and their earnings call. Basically, they said they kind of feel like they're in the area where they're going to normalize now. I think the market was originally projecting that they're going to have higher margins than they were, maybe like 13% bottom line margins. And now they're kind of pushing for probably about 10%. Yeah, we see 10.1% EBIT margins right there. So that kind of feels like where they believe they're going to end up on their bottom line margins. But we're going to have to see. It's really going to depend on the discretionary spend of the consumer, how strong the consumer is, which they said that their consumer was strong across every single demographic or price point demographic. So I don't know. If the economy gets worse, if we get into higher discretionary spend, then, they are probably going to feel it. And they're probably going to have elevated levels of theft and shrink for a while. But even with that being said, they're probably, I do think they are structurally better than pre-pandemic. So their margins probably aren't going to go back to pre-pandemic, but they could moderate down until we have a normalization. And, once the consumer gets into a stronger position and more discretionary spend, then we could probably see maybe a recovery back into higher margins as well. All right, with that being said, let's go ahead and jump into their financials on the spreadsheet. Now I had this new overview tab, which you guys just saw earlier, and we can go through some brief, overview here. If we look at their 5-year growth rates, we have revenue growth rates over the last 5 years have averaged about 7.5% CAGR, net income 26%, EBIT 22%, free cash flow 15%, operating cash flow 4%. So we do see those bottom line margins or bottom line growth higher than the revenue growth. So they're having some margin expansion. If we go to the margins section, previous year margins for gross margins is 34%, operating is 11.8, EBIT is 11.9, net is 8.43, free cash flow is 4.51. The 5-year change, or the change over the last 5 years, has been a positive 5.6% margin expansion, and gross operating has been 6.2%, EBIT 5.3%, and net 4.67%, which that's a really big difference on the bottom line. That's almost like double the margins that they were getting before on their bottom line. So that's pretty dang impressive. And we can kind of see that illustrated with this graph here, looking at gross, operating, net, and free cash flow margins. We saw a nice expansion coming out of probably 2019 up into 2022, and then a recent pullback. So we'll see how far back we moderate on these, how far back we normalize, but they have gone through a decent amount of top line growth, but really, really good margin expansion over the last several years. Now, the fear in the market would be that they're going to go back to previous trend where their net margin is like 3.7%. That's a huge cutback. So if we see that happen, this stock is going to get absolutely demolished because their bottom line numbers are going to be pretty rough. Bottom line yields, as far as the multiples go, they've traded anywhere from about probably, oh man, they're just all over the place. But on average, probably between like 7.5 and 13, 14, 15% across different bottom line metrics. If we're just looking at net yield, they're probably between around that 7.5 area to 15% area. All right, going to fully diluted shares outstanding, we see they had a decent amount of buybacks up until about 2020, and then they actually sold off a decent amount of shares in 2021. And I find this really interesting because if you go to the specific quarter by quarter, you can kind of see they started, I don't know if they were doing acquisitions or they just diluting into the market. This is really interesting because in 2021, like right at the start of 2021, actually second quarter 2021, they started diluting. They diluted up until 2022. If we go back to the chart, it basically started diluting like right here. And they diluted all through this pump. And then after, I think they diluted into, was it all the way to 2023? So, they're off. Their fiscal year's off a year, I think. Shoot. So they probably diluted going into 2021, and around 2022 they started buying back shares. So interesting that they did that. I want to get more information on why they were doing that. It doesn't look like it was just for a acquisition or anything. It looks like a pretty steady dilution stream. Now going into their income statement, we can see how their bottom line income changed drastically over the last several years as their margins expanded throughout COVID. Yeah, we have a decent amount of expansion through SG&A and operating expenses, but that's expected with the growth that they saw. EPS diluted increased nicely over the last several years. But going over to the balance sheet, we can kind of see the increase in debts over the last several years for their expansion and probably for a couple of their acquisitions as well. So their short-term cash on hand is about $2 billion. So that's pretty decent. They've got $2 billion on hand, and their debt balance is about 3.7 billion or so. So not that bad at all. Now getting into goodwill and intangible assets, pretty steady. Goodwill has been pretty steady. Intangible assets has been going down relatively steadily as well. Getting into the free cash flow statement, we can see their operating cash flow. Yeah, choppy, but growing overall. Stock-based compensation is pretty low. And then we get to their free cash flow, and they've been doing a decent amount of stock repurchases and then dividends as well. And then getting into ratios and metrics, this is another good example or visual of their margins over the last 10 years. You can see kind of their margins just flatlining and then just boosting out of COVID and having pretty high margins. So yeah, man, if those margins go back to where like pre-COVID levels, this thing is going to get absolutely destroyed. It'll be rough because, you'd be looking at years of probably declining bottom line income. So I don't know. We'll see. We shall see. Per share metrics. Obviously, we see a huge jump in per share metrics as those margins expanded in 2021, 2022, 2023 is pulling back a little bit on us. So yeah, we'll see. It looks like, long story short, maybe the market had a justified reaction to this. Dividend payouts, they've been paying a dividend for a pretty long time now. And looks like they just upped their dividend. Yeah, looks like they just upped their dividend to about $1 a share. So that would be almost a 4% dividend right now. Dang, what's their payout ratio? Payout ratio is about 35%. So not horrible, but could definitely be in jeopardy if we do see further margin compression as we see normalization. All right, so common stock repurchase, we see, decent amount of common stock repurchased. And we can see that through the decrease in outstanding shares in the income statement as well. After they diluted for about a year and a half or so, they started buying back again. So pretty interesting regarding that. And then here we can see kind of their dividends paid versus their net income, their operating cash flow. I wonder if those two $1 dividend payments was kind of like a special dividend. I kind of hope it was. I hope it was a special dividend and they just have a low dividend payout. I'll look into that real quick actually. No, it looks like it's a dividend raise. So it looks like they raised it from, Well, we have 27 cents, 36 cents, special dividend of 5.50 in 2021, so that's nice. 43, 48, and then a raise to $1. So yeah, it looks like it's about a $4 yearly dividend. So at $100, you're looking at around 3.58% dividend yield currently, and about what we say like a 35% payout ratio, something like that. So yeah, pretty interesting there. We'll see if that, I don't know if they have that margin compression even further, and this gets into pre-COVID levels, their dividend might be in jeopardy. But it would have to get pretty bad for that. Looking at their total debt versus their operating cash flow, they're not too bad. They're not too leveraged. It looks like their cash flow coverage ratio is about 21%. Their interest expense operating cash flow ratio is 10.33%. So not horrible on their leverage. Now let's get into the valuation. All right, so here are the valuation template, and let's go look at the yields over time. Yield multiples over time. You can kind of see they're all around the place. So for the valuation, I kind of used a yield spread between a yield multiple between 8.34 and 16.55. This is a tough one because I'm planning out currently from here to have a bit of growth on the bottom line. So I don't know if we can do much more than this. 7.5% in the base case, or the most probable case, and about 11.74% multiple. Yield multiple at the end of the 5-year period. They're going to have about 3 or 4% commitment to dividends. So buybacks are probably going to be best case 5% or so. But yeah, buybacks can probably be 5% to 3.67%, something like that. I would not be opposed to them cutting the dividend and doing increased buybacks, assuming they were healthy and they're trading at like a 10% yield or something like that. That'd be pretty dang good. So dilution, we got buybacks from, let's actually change this. I'm going to do neg 25. I want to see a lower. Yeah, let's do neg 20. So dilution, we got 2.29 to 5.6% on buybacks. In the various scenarios, bottom line growth, we've got 5.4% to 10.45%. That's probably actually a little bit too bullish. I'm going to do a little bit worse than that. Let's do, let's do that. 4.41% bottom line growth to 8.45%, just because I think there's a higher probability that we have further margin compression in a weakening consumer environment, especially across discretionary spend. But if they pull this out and flatten margins out and continue to grow at a decent 7% clip or something like that, their bottom line growth could be easily 6% or so. So I feel pretty comfortable with that in the base case. Overall yield spreads, like I said, or not yield spreads, but ending yield multiple in the best case scenario, 8.34, worst case scenario, 16.55. And that's kind of the spread that we've seen previously. It's kind of been all over the place. I would hope that we'd moderate between this, like probably 7.5 to 12.5 or 15% range. So we're kind of in there. The bullish case might be able to be a little bit better. But yeah, this is what I kind of feel comfortable with, because I think there is a pretty good probability that we do go through further margin compression, and this one could be a wild ride until the market really has confidence that their margins have stabilized and they really know what they're working with. So under these various scenarios, we have a target rate of 15%, and then on top of that, like probably around a 3.5% dividend. So CAGR would be about 18% target on this, assuming the inclusion of the dividend, 15% CAGR on the equity price alone. In these various scenarios, oh man, we'd have a scenario one buy price, like not worst case scenario, but pretty bad scenario, $58. Scenario 2 be 73. Scenario 3 be 94. Scenario 4 would be 123. Scenario 5 would be 163. And I might just be way too cautious on this, but I don't know. I think they don't have like they've already grown a decent amount, and I don't know if their growth can make up for their compressing margins for their bottom line income going forward. Just as an example, or just to give you an example, the base case in this scenario, we would have EBIT of 1.7 billion in year 5, net income of 1.3 billion in year 5, free cash flow of 1.4 in year 5. So that's pretty much what that's probably around previous highs of COVID. So I think we're going to see some normalization from them. But yeah, in these various scenarios, the scenario 1, our 5-year target would be 116. Scenario 2, the 5-year target would be 147. Scenario 3, the 5-year target would be 190. Scenario 4 would be 247. Scenario 5 would be 329. So currently, we're seeing in the buy ranges for the scenario 5 and scenario 4. Scenario 3, which is kind of our base, we're not really there yet. But honestly, if you were not as conservative as I am being, you could probably easily get there. Or even if you just change the KGAR to, yeah, we're almost there on if you're just looking for probably a 15% total KGAR between the price appreciation and the dividend, we're probably there right about now. So it'd be 106. So yeah, I don't know. This is interesting. Personally, I kind of like ASO more because I think they have a better opportunity to grow. They're a little bit smaller. They have a little bit more growth runway ahead of them. So they could potentially, in like I don't know, if margins normalize, they still have the ability to lift their bottom line net income numbers through growth. So yeah, DIX is looking kind of interesting. If I got into that like low hundreds, 90, 80 area, I think I'd be a lot more interested. So we'll see. Yeah, my views on this one might change a bit pretty quickly, especially if we kind of see that their margins are normalizing. If we get a couple quarters of margins like flattening out and accepting the new norm, then there's probably like less risk associated and you can tighten these down a lot more. But right now we're baking in a pretty wide spread just for the uncertainty of how bad margins are going to get going forward in the next year or 2 or 3. So if those margins do stabilize, then we'll probably see kind of the valuation stabilize. But yeah, we'll see what happens over the next couple quarters, next year or 2. Hope you guys enjoyed the video. Have a great day. Hope you had a great week, and we'll catch you later. As always, this is not financial advice. This is just my musings and looking over another company. So do your own research, your own valuation, everything, and do not, buy or sell or do anything based off of a guy, on YouTube.